You're listening to Brian Buschlach's Business Briefing on AM 770 KTTH.
Well, I know it's August, but never too early to start considering your tax planning, especially those of you who have extended. We talked with Michael Lortz at Geffen about that in our last segment. A couple of tax deadlines looming on September 15th and October 15th. Also, as he called it, a potpourri of tax information, including good news when it comes to Washington's B&O tax. Well, Michael, business owners are always complaining that taxes keep going up, Obamacare, etc. Well, there's good news. The Washington B&O tax actually dropped. What happened?
Yeah, that's right. In fact, I had clients contacting me asking if there was a mistake on the forms when they saw this. So what happened was back during the recession, the state of Washington was looking for ways to increase revenue. One of the mechanisms for that was their B&O, or business and occupation tax, and that's a tax based on gross receipts. It has different rates depending on the industry that you're in. For service providers, they raised it from 1.5% tax based on gross receipts. It has different rates depending on the industry, but that was temporary. And as of July 1st of this year, it's back down to the 1.5%. People are shocked. And interestingly, this impacts not only firms in Washington, it also impacts firms in other states who are working on projects located in Washington. For example, I work with architecture firms that are doing work from Oregon on buildings located in Washington, and this tax impacts them as well.
Yeah, there was quite a bit of publicity about the fact that the state of Washington was tracking these Oregon businesses and the way they were doing it, and many of them unknowingly filling out this form for the state of Washington, right?
Yeah, that's right. In fact, I would say that during the last 12 months, we have seen with our Oregon clients more audits from the Washington Department of Revenue than we have seen in the last 5 years combined. It's amazing. They've really discovered that there's a lot of potential revenue with Oregon firms doing work on Washington projects. That plus some Oregon companies will have a small office located in Washington, and they owe use tax on items they buy in Oregon and ship up there. So the audits have been very successful for the Department of Revenue.
Michael Lortz at Geffen joining us here on Business Briefing. You know, it's interesting because there is so much business opportunity across Puget Sound and Washington on the leading edge of that, and so many of the Oregon firms obviously realize that and take advantage of it because a lot of the crumbs that fall off the table in Seattle are bigger than what you might find in Portland, so there is quite a bit of business to do up there.
Yeah, that's right. In fact, a lot of our Oregon firms have been looking at expanding into Washington, or those that already have offices there have been expanding those offices. We're seeing a lot of growth in those Oregon companies doing business up in the Seattle area in particular.
And we're starting to see business pick up across the Portland, Vancouver market as well. Let's shift gears now and talk about vacation rentals. We all work hard and we sometimes acquire those vacation properties, and I know that there's some tax that sneaks up on people.
Yeah, there is. Believe it or not, what most people think of as a very simple activity, simply buying a vacation home and then renting it out to folks maybe for 1 week at a time during the summer, or perhaps it's at the coast, and there's a lot of folks that want to stay at the coast around the year. That sounds very simple. And, if you have a property manager, it is simple. But if you're managing that rental yourself, technically you should be collecting and then paying lodging taxes. Both Oregon and Washington have state lodging taxes that apply, and a lot of cities and counties do as well. And to make matters a little bit more complicated, many times the city or county rules on whether or not tax applies, they'll tend to vary from the state rules. But what you're normally looking for is most of these taxes all use this concept of transient lodging. And what they mean by that is if somebody is staying for less than 30 days at the place you're renting, they call that person a transient lodger, and they expect you to collect tax and remit it to them.
Airing across Puget Sound on AM 770 and in the Portland market on FM News 101 KXL. This is Business Briefing. We're talking taxes with Michael Lortz at Geffen. And for our listeners across Puget Sound, I talk Oregon tax because I know many of you have relocated from Oregon. There may still be some impact there. There's some interesting things happening, or that have happened in the Oregon market. This Conway case in particular, Michael, tell us about this one.
Sure. So Oregon has a minimum tax on C corporations. And what that means is even if a C corporation in Oregon has an unprofitable year, they're still going to owe some income taxes to the state of Oregon based on the amount of Oregon gross receipts that they have. Well, many Oregon companies have accumulated tax credits over the years, perhaps for energy efficiency projects, research and development. So it was very frustrating to these companies that they were paying this minimum tax and they weren't able to use the tax credits that they have accumulated against that tax. That was the position of the Oregon Department of Revenue. Well, one taxpayer, Conway, didn't like that, went to court, and prevailed twice, most recently at the Oregon Supreme Court. And now, nearly all of the tax credits that Oregon has are now able to be used to offset that minimum tax on Oregon corporations.
I think that business owners across the state should be taking the executives at Conway out for a nice dinner, maybe at El Gaucho, huh?
Absolutely. I was applauding their resolve, and it's very nice when a taxpayer puts forth the time and expense to handle something that applies to a lot of other taxpayers.
Well, in the Only in Oregon file, there's a proposal, if you will, to raise Oregon taxes again and again for the folks who live in Seattle now who have migrated, shall we say, from the Oregon market to Seattle and Puget Sound. They'll get a kick out of this. Tell us about it.
Sure. So Our Oregon is a group that is typically affiliated with unions in the state of Oregon, and they have floated a number of ballot proposals. They've submitted 4 initiatives, and I'm only going to mention one of the 4, but it's a tax increase on individual income tax rates. Now, Oregon's rate currently at the high end is 9.9%. Their proposal would increase that all the way up to 13.6%, which is a dramatic increase and would be the highest in the nation.
Well, Oregon maybe wants to be number 1 in something, Michael. This would be right there at the top of the list.
Absolutely. You know, California increased their rates not that long ago. They're up to 13.3, but we always like to one-up the Californians here in Oregon.
They're moving here anyway, right? So might as well tax them like they're in California. That is very interesting. I would have to say, and I would like to get your input on this, probably not much chance this is going to go anywhere.
That's what I'm hearing. There were a number of attempts to increase Oregon taxes in the legislative assembly that recently dismissed, and none of those really went forward. My guess is this one won't either.
Okay, and finally here, another Oregon tax credit auction coming up in late August. Tell us about it.
Sure. So we just had one end in July that was for tax credits for the film office. There's another one coming up in August related to some Oregon energy incentive tax credits. This is an opportunity for taxpayers to bid on these credits, buy them, and reduce their taxes.
It's a great program, so we have to give Oregon credit for that. They do have a phenomenal tax credit program. And here we are in mid-August. It is, the dog days of summer. As we mentioned in our last segment, been very busy for most professionals across the Northwest. We have some tax deadlines looming here in September and October. It's going to sneak up on us here, 30 days away from corporate, right?
Yeah, that's right. Pretty much any of your business returns are due September 15th if they were extended, if they're a calendar year end, and then individual returns due October 15th. For our clients, this is also a great time to do planning. Start planning now for the end of the year. There's a number of tax provisions that will end this year, and we really want to make sure people take advantage of those before we get to 2014.
Well, that's great advice because I know so many businesses have done so well this year. And as you mentioned earlier, we've come out of survival mode, and now there's this opportunity to do a little more advanced planning because there's more cash flow, more revenue, right?
That's absolutely right. In fact, we talked about growth. There still are some good depreciation incentives related to financing growth. So, for example, we still have this 50% bonus depreciation that companies can claim on new fixed asset purchases. And then for small businesses, we've still got this Section 179 of $500,000 where they can expense the first $500,000 of equipment purchases this year. But as of now, it ends this year.
And you can reach Michael Lortz via email, mlortz@gmco.com. Next question, how many Sherpas do you need? Greg Bell answers that question up next on Business Briefing.